Welcome, YouTube family, and welcome to the Kevin Strong Show. And in this video, we're going to talk about how mortgage rates are rising. They're over 5%. That's the highest that 30-year fixed mortgage rate has been in a decade, and it's going to get a lot higher. This is basically going to strain the middle class, widen that gap between the have and have not, and further exacerbate home affordability in the United States. So without further ado, let's get into this article. Once again, it talks about mortgage rates hit 5% for the first time in over 10 years. This is a big deal because a lot of times, let's go back to like 2008, rates were a little bit lower. But the problem what people don't understand about this is that in 2008 to 2000 and let's say 12 or 11, rates were actually coming down during the housing market debacle. So as the housing market was crashing, rates were actually going down. So you can't necessarily say with 100% confidence that if rates come back down, that's going to reignite the housing market. There's a possibility. There is some talk out there about a 40-year mortgage. That's going to lower your payment by about 33%. Obviously, going from a 30-year to a 40-year term. That's basically going to keep people in debt for a very long time. But the American psyche is fixated on monthly payments. And by creating a 40-year mortgage, that's going to significantly lower the payment, probably make affordability a little bit better. But at the end of the day, it only remains to be seen whether or not that's going to be the silver bullet that reignites the housing market when it does decide to pull back. Once again, I am on record saying that rates are going to continue to go high, but in the next 12 months to 18 months, probably closer within 12 months, you're going to see the Fed reverse its course and rates will start to come back down. This is not financial advice. This is just my editorial opinion about what mortgage rates will probably look like in the next 12 to 18 months. So let's dive into this article and let's talk about this. Right here, the 30-year fixed rate mortgage averaged 5% in the week ending in April 14th, just a couple of days ago. That was up from 4.725%. And that's according to Freddie Mac. That's the highest since 2010. Now, see, keep in mind, we were already well into the financial crisis and the housing crisis at that point in time. So you're starting to see some similarities here between what's happening now and what happened in 2008. A lot of people in the mortgage industry are also starting to come out with these ARMs, adjustable rate mortgages, or teaser rates, if you will. Some of them are fixed for anywhere from 3 to 5 or maybe 7 years, and then they start to adjust thereafter. People are flocking to these teaser rates because, once again, people are fixated on monthly mortgage payments. And by doing that, they're not really forecasting what a payment shock that's going to be once that rate starts to adjust. Rapidly rising rates, along with sky home prices and rapid inflation, continue to push home ownership out of reach for many Americans, Sam says from Freddie Mac. So this is what I was talking about earlier, kind of laying this article out for you before we started to dive into it. This is a really kind of precarious situation that we're in right now, because I think so many people are analyzing the housing market strictly from either just interest rates, which is obviously what this article is about, or they basically put their hat on the inventory level. And both of the aforementioned are really key points into predicting how the housing market may perform. But we've got some things now that we're dealing with that we haven't seen. Inflation is rising at a rate we haven't seen since 1981, probably ever. Once again, I'm also on record for that. We will see inflation. We may even see hyperinflation. But in the next 12 to 18 months, I think you will see a deflationary period. But before we get to that point, inflation, things like gas, energy, your food bill, things like that, that affects your after-tax dollars. And people are starting to not feel confident about purchasing a home. And then what exacerbates that whole process is that mortgage rates are going up on top of all of these other costs that are rising. So it's almost like a perfect storm in a bad way. This week, mortgage rates averaged 5% for the first time over a decade. I just kind of went over that. So let's look at some of the things right here. The sticker shock is particularly painful for first-time home buyers. says George, right? A senior economist and manager of economic research at realtor.com. He noted that the monthly mortgage payment for a medium price home is now $530 more than a year ago. Okay, adding more than 6,300 to a homeowner's annual budget. That's a big deal. So think about that, $530 per month. So how much has your gas bill gone up? How much is homeowners insurance gone up? How much is your food gone up? So this is kind of like that old Chinese proverb, death by a thousand paper cuts. This is really, really eating away at people's disposable income. And that's why I mentioned those other variables about those things are just as important when you start analyzing the housing market and not just particularly look at inventory and interest rates. I think we're in a totally complex and very fluid economy. And I think there's a lot more variables involved that could ultimately affect the housing market. And you can't necessarily use those same measuring metrics that you did back in 2008. And I think that's where people are missing the boat. Down here we go. Higher rents are encouraging many tenants to take a second look at buying a home, especially in cities where a mortgage payment may be on par or lower than the monthly payments. On the other hand, for the for sale market continues to be undersupplied, making it difficult to find an affordable house. And then that's the quandrum, right? Rents are definitely going up. Home prices are going up. Another good matrix is, and I'm not going to get too technical with this, but when you start to see the average wage or the average income for a particular housing market start to really separate from how fast the housing prices is going up in that area, that's an indication that something's probably getting ready to pull back, because that type of stat clearly shows that there's an affordability crisis because wages are not keeping up with inflation, and wages certainly are not keeping up with the rising cost to afford a house. So I'm going to pull down here a little bit because I don't like when people just read everything in an article verbatim. It kind of makes it a little boring. So I kind of take some snippets out of the article and then add my own editorial piece to it. The Federal Reserve's plan for reducing its balance sheet, its holding of U.S. treasuries and mortgage-backed securities was slightly more aggressive than some market participants expected. So basically, when some people say, the government is really involved in mortgage-backed securities, and without getting into the weeds of that, it's basically they're buying a lot of the mortgage on the secondary market that basically frees up the mortgage industry and allows it to continue to go. If they hold true to pulling back some of these mortgage-backed securities, you will see that being a significant blow to the housing market. But once again, they may only do that for about 12 months, and then they may start to rebuy those mortgage-backed securities, thus putting a little bit more fluidity back into the housing market. So I think that's going to kind of do it for this particular article. I didn't want to jump around too much. I just wanted to kind of, reach out to you guys and talk to you about a few things. I do apologize for not having a video for a while. My good friend Don Hamilton was like, "Hey man, I haven't seen one of your videos. I kind of look forward to that." So I do apologize for not getting a video out. I'm going to try to be a little bit more consistent with that. I've been really, really busy with marketing real estate nationally. So that's just something that I'm doing on the side. But nevertheless, I hope you guys are enjoying this content. You know my motto: please keep your credit score up and keep your debt down. Please comment, like, and share because I care. And if you do enjoy this type of content and you want to get notifications when something like this comes out again, please subscribe and share this video. I hope you enjoyed this edition of the Kevin Strong Show, and I'll see you in the next video.